All right, so we are live now, and we'll see as people kind of flow in here. And hello to anyone that's actually watching the recording. You know, in the future, because this is our first time going live with this, in the future, we could probably start this up and let people kind of trickle in early if they wanted to. Yeah.
I think there's a way to do a countdown on YouTube. So yeah, that'd be good.
Yeah. As you can see, there was a comment that got shown up. Fun times already. Yeah, going from private to public, it's an interesting deal, right? You know, because I've always done this with like a private group, you know, inside, or at least subscribers that stay with us, and so they've got a decent amount of back history of kind of things that I talk about. So, all right, well, we'll just kind of kick it off, and we'll just kind of get started in general with a decent amount of overview of just kind of what's happening. Today was Fed announcement day. So if you guys pay attention to markets or macros or anything like that, it's a decent event. So here I will show this up and we'll talk about this. So Fed announcement, we moved our base rate up to 4.5. And we are now pricing in that we're going to start to clip at 25 basis points per meeting now. So that's kind of a new thing. Remember, we are... for those of you guys that have followed me for a little while, we are in still a Fed tightening regime and a slowing GDP, especially year over year. And we also have, right now, nowcast models, which we'll talk about, at least the GDP now is saying that they're positive Q over Q. But right now, at least my models say they're negative Q over Q. So what that kind of means for us is that in general, in the macroeconomic environment, we are favoring, especially late stage in the recession, which is where we are favoring bonds and precious metals or golds. And so that's what, if you're a Sleep Well portfolio subscriber or an Awake subscriber, you know that that's where we've been, and it's been phenomenal all year, and we've been outperforming the markets so far. So we, as far as like the Fed tightening, what's going on? Well, in general, let's just kind of see where we are on tightening, right? So as far as what the market's pricing in, so this is I always try to show something as far as like a website or something that you can just get to really easily. So you can kind of pay attention to these if you want to, rather than depending on me or my models. So in general, market's pricing in that we are going to go up by 25 basis points next meeting, which is in March. And then May, we go from 475 to 475 is basically what we're pricing in. So in general, the May meeting doesn't look like it's pricing in a rate hike right now. Now there's a little bit over here, but as far as the general consensus is that we're not going to lift rates any higher after this next meeting. And then in June, so 475 was our main point. Yet again, it's still 475. So no interest rate hikes in June. In July, no interest rate hikes. And in September, no interest rate hikes. Now, this is something to also note that in general, where we're looking at is that for the first time from July over to September, is that the odds, at least for like if you were to look at the bell curve or the betting curve, if you kind of want to say it like that, is starting to push over onto the rate cutting side. So we were pricing in a rate cut in September. That has now been kind of erased, but you can still see that it's leaning over towards a rate cut. In November, 450, 475, you can finally see that in November, we are pricing in a rate cut. At least that's where it's starting to push over to. Still not like a for sure thing by any means, just because we're so far out. And then December, you can see that it's definitely another rate cut. So where is the tightening cycle? Where is it going to end? Well, right now we're slowing down. So if I wanted to, kind of just in general draw this, you know what? I don't have a way to draw actually right now. Now that I think about it, I can just grab this and I will kick it over onto this. Give me just a second here. So if I was going to kind of draw this, what's kind of going on right now is early last year, we were starting to tighten, right? So that's the Fed was growing their balance sheet. Everything was getting better. And then all of a sudden we start tightening early last year, tightening. And that kind of accelerated all year long. It was really kind of coming down. And right now what's happening is that's starting to slow, right? The tightening effect is starting to slow. So where are we in the cycle, right? This is super easy stimulation money right here. This is, hey, we're transitioning, right? We are transitioned and tightening. Now we are in transition, right? You can kind of see that transition already starting by where we are. Now, right now, we're not flat by any means, but we're basically one meeting out from the Fed at least stopping their interest rate hikes. We'll see what happens with their balance sheet. Right now, they're still reducing their balance sheet, which is still a tightening effect. So even though this is slowing, we are still in a Fed tightening mode, right? And when you're in a Fed tightening mode and you've got slowing GDP year over year or quarter over quarter, and then we also have disinflation at the same time, that's normally not a great situation for stocks. So that's also why the portfolio is away from equities right now. Now, of course, that can all change because government spending can come in, which is exactly what we've seen here recently. Lots of government spending is a very big stimulus, especially when that stimulus or that spending goes directly into businesses that are going to profit from those things, and it can retain profits. So financial assets typically grow during that condition. And if there's enough spending to offset the Fed tightening, right, then you basically end up not being in a tightening cycle anymore. You're actually in a stimulative cycle. And that's kind of what we've had in the middle of this recession. So we'll see what they do. They're trying to, hold everything together, even though we're tightening and we're going through a pretty nasty recession right now. And we've still got the last half of it. But we're basically starting the final stage of the recession, which is the stimulus section, which is right before we enter a bull market. That is about ready to kick off. So we're kind of starting that a little bit early before the really deep dive of GDP, and really we all kind of feel the recession more in the later stages. All right, so that's where we're at as far as that's concerned. Now we'll go. Let me move over to. Let me move back over to. Yep, there we go. All right. So Michelle, you can see my GDP now, right?
Mm-hmm.
Perfect. Okay. So this is just something to give you just a basic overview of what's going on, quarter over quarter, or at least what's likely projected. Right now, we are actually positive quarter over quarter, which conflicts with like the general consensus, and it does also conflict with my models as well. My models say that we're going to be negative, my models actually say that we're going to be decently negative quarter over quarter, but it is what it is. So right now, as far as the data is that gets set out, which you can kind of see the subcomponents down here of what's actually pushing towards positive, and we'll see what ends up happening by the end of this quarter. But so far, it's starting out a little bit stronger than we originally anticipated, and that might be due to also some excessive, or not excessive, but some more government spending. All right, something that we've talked about is yield curve. I really like this website. I mean, I know there's tons of ads on it right now, but it's just a great little website as far as just kind of seeing where things are, where the Fed's at, and what the yield curve kind of looks at in general, right? Where it's been, where it's going. So January 27, 2023, you can kind of see here that we have inverted further, right? And, you know, the interest rate hike coming in here will actually invert this further. But this is the very important part that I wanted to discuss, is that late stages in the recession, this is when you get the back end of the yield curve sinking down and this staying up until eventually the Fed, you know, the Fed or markets kind of concede that it's coming down, right? Nothing, we got to stimulate, we really drop down. And that's when the front end of this curve will drop down. And that's when inflation really cools off and things like that. So that's where we're at. And then you can see here on a historical basis how inverted the yield curve is. Yet again, very much flashing signs that we've got some issues going on. Something to note, you know, everyone talks about, oh, the yield curve, this is when things get bad or whatever like that. Something to note is that typically, you know, at least historically, it's when the yield curve uninverts that we normally call that it's actually a recession. So we've inverted already. And so we know that we're already tightening. We already know that financial markets are tightening. And we called it, at least in December of 2020, that we were going to go through a recession. Well, we did have a recession in the first 2 quarters of 2021 or 2022, right? And now that we're in 2023 and we've had a couple positive quarters back to back, we now have this second level of recession that's coming through. So we kind of had this financial market tightening, and then now we're going into this, just to kind of give you an overview of where we are in the cycle. When this thing pops up, it's going to be near the later end of the recession where it's really kind of nasty. And then the economic recession will really kind of sink in, but the financial markets literally typically won't go down too much deeper after that kind of kicks in. And then finally, as far as inflation, you know, we are slowing as far as that's concerned on a rate of change basis. And homeownership affordability, I always just kind of bring this up in general, is basically at the lowest level it possibly can. And you can finally see that the price year over year change is starting to actually slow down. Now, it doesn't mean that prices are technically coming down, even though they are in some areas. Like, so I'm in Seattle, Michelle is in Oregon, right? So in general, in our areas, prices actually are coming down. I think we're like 18% year over year or something like that. But not everywhere across the United States is actually seeing negative price growth year over year. So something to keep in note, and that's where that is. So that's our main overview. And from there, we had a couple questions that got sent in. So we're going to go into that now. So Michelle, what was that?
So we got a question about broken wing butterflies that have a really flat expiry line, and if they are not a safer way to trade and keep your accounts P&L stable rather than trades that are more directional.
Okay.
Or have more gamma to them, I guess.
Yeah. So let's kind of break that down into like what that question is. So this is a complicated options structure, complex options structure that we're kind of talking about. So let me pull up an analytics software and we can just kind of throw up something and we'll talk about what we're talking about here.
Hi, Greg. Yeah, flat T plus 0 line.
Perfect.
Is the goal. Yeah.
We are going to talk about that. This is going to be a fun one. So let me share my screen the proper way. Stop share. All right. You can see my Oni, right?
Mm-hmm.
Okay. So if we're talking about this in general, like what's a flat T plus 0 line, right? So let's just make something with a flat T plus 0 line. I came back here to February 2018. We can go to any time frame in here, but I'm just on this. There's there are times where flat T plus zero lines and directional trades are going to be advantageous, right? But the question that I would ask at the get-go is, why are we trying to have a flat T plus zero line? Is it because there's a lack of edges in the market, such as like options aren't mispriced anywhere, or that there's not really any kind of overextension or aberrant behavior that we can grab onto? Or is it just because we have an edge in this one spot and statistically we just want to run it forever, right? And there's a lot of times that we'll find an edge in markets. So like for the S&P 500, right, the SPX, in general, put volatility is elevated, right? But there's something to note that in general, that is true. But how we capture it like as a retail trader, right? I'm not going to talk about like the hedge fund world, because when we do things in a hedge fund world, we can use margin that's not available to retail traders, and we can do trades that aren't available. We can take an excessive amount of risk sometimes that it's just not going to be allowed in retail trading space. So as far as retail trading space, typically what we'll do is we'll have some sort of spread on, right? Well, spreads are very sensitive to the difference between your short and your long, right? So yeah, even though we have general elevated volatility in the S&P 500, if we just slap something on, so here I'm like 43 days, we'll just go negative 200. And Greg, you sent this up since now that we're talking about this, and we're going to just kind of model this in general. So here we go. Here's a nice flat T plus zero line. If we zoom in really close, right, it looks really pretty safe. Let's kind of get our, quote unquote delta down to something that's reasonable. We can bring this down to like 80 and 20. So there we go. So there's a good starting position. And this is a really common trade, right? This is a super, super common trade. And this is zero delta. So directionally speaking, we don't have any risk, right? But now the question is well, what do we have risk on? Like, where did we put our risk? Well, we don't have directional risk right here. We have directional risk way behind the market, that's for sure. So let's look at where that is. 2,600. 2,600 is what's here? Right around here, right? So that's a long way down on this market. Volatility is super low right now. It's only like 12, right? And the point behind this is okay, is it a good time to take well, no, we'll come back to that in just a second. So perfect. Let's just go ahead and commit this thing, and we'll just call it whatever. We'll just leave it. All right. So we basically have flat delta. Everything's gravy. Everything's fine, right? Now, what's the risk that we take on this trade? Well, if we just look at our Greeks, and you guys will find out that I'm not a huge, proponent of like Greek trading. I'm more of a market environment trader, right? So I'm just, anyways, we'll get into all that someday, I'm sure. So as we sit here and go into this, what is my risk on a Greek basis, right? We've got a lot of negative vega on this thing, right? We supposedly have theta. That's the most garbage number you'll ever see. So you can basically ignore that, throw that out the window. Your gamma is -2, right? So we know that we have some sort of like dome structure, but it's really low. Now I say low, some people might look at that, gamma and be like, oh my God, that's a lot of gamma, but that's just a derivative of how much capital I have in the trade as well, right? So this is almost a $500,000 trade. I'm used to putting 100 lots on here. So that's just kind of the way that I throw things up here. But anyways, now that we've got this set up, our delta is supposedly 27. The closer we get to 0, the less delta actually really means to us. It's more about gamma then, not delta. But the larger the asset, the higher the volatility, the more delta is an impact on the trade, right? Because if you have a bigger asset with higher volatility, then you're taking more risk per point, right? So it's gonna blow up a trade, anyways, or it'll make a trade awesome. So now that we've got this trade on here, it's a nice flat T+0 line. We've got all this safety, and this is like supposed safety. Look, if this market, keeps going up, because this is just a small pullback, and it keeps going, then it's normal, right? Everything's gravy. Now that we've got this, if we move forward, because we've got all this vega, right? What is that vega going to do to us, right? Is this a truly non-delta based trade, right? Okay, well, great. We had a small down move, no big deal. It handled it well, right? So the question was about, can we just put on a no touch adjustment type trade and just leave this on all the time, and this is what's going to work? And sometimes it can. The catch is that when it doesn't work, what does it look like, right? So intraday right here, we had another drop, and this wasn't anything, crazy, but you can see here, this was down 10% at some point, right? This was down significantly further down here at 17. Maybe you check this and you're like, hey, I'm fine. This is okay, because so far this has been low volatility all the way up. Everything's fine. We should be able to handle this. And then you go one step further, and this is when these types of trades really have their problems, is when they get really blown out to the downside, and you get something like a 15 or 20 or something even larger than that. And how many months does it take you to come back from that loss? Sure, you can do that. So, but if you're only looking for 2-3%, right, and your losses are, say, 15, or your losses are 20, or something like that, you've got a problem. So you got to look at your average loss to average win. And that's what really determines your... It's what really determines your expectancy, right? So you can do it. I'm not saying you can't do it, but what happens is you end up getting a profile that starts to mirror what retail traders have been conditioned to do, which is, let me take a small win, small win, small win, small win, small win, and then boom, you take this big nasty hit, right? And so the reason that I kind of zoomed in on this exact day or this exact period is because I know some professional firms that blew up on this cycle that were doing exactly this methodology of, here's a trade that's a no adjustment, we're just going to stack on this edge. And they had hundreds of millions of dollars at risk, and they blew up, right? They owed the broker money at the end of the day, right? And this is what happens to these types of trading systems, is that you get these small wins, small wins, small wins. You size up, you scale up, you feel good, everything's gravy. And then all of a sudden it stops working and you blow up, or you just have a problem, right? So yeah, let's see. Comment. Yeah, not all broken wing butterflies are greater equal. Exit at short strike, short expected move. So now what we're talking about is putting in a risk, like a risk management strategy on top of the broken wing butterfly strategy to take care of this inherent flaw in the actual system. Perfect, right? So now you've got this management system that's going to overwork on it. And then now you've got a working setup for the future. Fantastic. There are also times that broken wing butterflies just don't have a lot of edge structurally. I'll get into that another day. The point being is that when you start getting into these systems, it's great and it might feel good and it works and it can have positive expectancy and it's a great system. And I'm not going to say it's bad. I'm not going to say it's a bad way to trade at all. In fact, it's a fantastic way to trade. I think that you should have one of these trades in your overall, options portfolio, right? Because it fits a certain niche, right? It takes care of a certain edge that's, say, always there, and statistically you can manage it and it works out well. Now, is that the same as taking on directional risk, right? Is that the same as taking on something that looks a little bit differently. Like here, is it the same as taking on, here, let's go back to the beginning of this. Where was I? I just grabbed a random date, the first. So sometimes, I wouldn't say that necessarily there's a directional edge right now. But there is actually a few components back here that I'll talk about another day that this had a very, 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 very solid profile of an asset bubble, right? And asset bubbles need to correct themselves, and the longer they go, the more the snap is going to happen, right? So anyway, so if you come in here and let's just say, I'm trying to think of the overall environment that this was in. Okay. Let's just say, let me look at my metric. Hold on. Okay. Let's just say, we don't want that type of strategy on. Let's say that we want, a different type of structure on. Okay. Here we go. Let me make this. Okay. So this is a directional trade, right? And of course, we know that this thing's going to blow up to the upside, right? If this thing is wrong. Let's overlay this with that other trade that I had on here, and I will separate them, and I will see if I can kind of match them in general and just try to get at least close to it. Okay, so as far as your longer, or like your quote unquote directionally safe trade, let's make this a little bit smaller. We'll probably put this down to 50,000 or 50 contracts. And there we go. Okay, so I've got a directional trade over here that really it stands to lose. I mean, let's call it, let's say that this is the same amount, like this is the same account. And so what I've done here is I've position sized the directional trade inside of the same account. So let's say you put 100% of your capital into this thing because it feels safe and it feels non-directional and it's like just stepping on an edge. Well, the fact that it doesn't have a lot of volatility in it, right? It doesn't have a lot of ups and downs. You can only get maybe 3% on average per trade. Maybe it's 5%. Maybe your profit target's 5%, but your average win probably isn't that much. And your average loss is probably a little asymmetric. It's probably, maybe 7, or it's probably 7, which is roughly, 2, maybe a little bit past 2x what your average gain is. And then if you try to compound that with, like, let's say you've got an 80% probability or so like that, you can see where your expectancy kind of ends up getting down to. It's still positive, but it's not crazy good. And the risk profile of it looks different as well. So if you can kind of imagine the risk profile of these flat T+0 line trades or those types of things it's more indicative of something that is, up, little trickles, wow, right? And you get these big like hits, so wow, wow, right? And this is actually very similar to like our 0 DTE calendar-based trade, right? We just hit a new recent high on that just a couple days ago, but the way that system works is that it loses bigger than what it wins, but it wins more often than it loses. So yes, it's got positive trade expectancy, but the whole feel of it is you feel good for 5 or 6 days or 4 days and 5 days. You feel great, right? You're like, oh man, I'm on top of the world. And then you feel like utter dog crap on the day that you lose. And that's kind of how a lot of these options income trades ends up being. And there are just other edges that we can step on that can make this a little bit better. But as far as this goes, let's go back to our example here. And if we're looking at this from this lens, right, zoomed out to equal portfolio sizes, right, does that calendar trade look super scary, right? I mean, well, it does if we take this and we just look at it on its own. We're like, oh my God, that thing is super directional, right? Like that's insanity. Well, yeah, but if we put it into a perspective of both trades, does it really look that aggressive? You know, if this thing can lose, say, 10%, right? The difference in here is that I've got positive gains to the left, I've got negative. So I'm actually putting my risk to one side. This big trade put its risk somewhere too. It was to the bottom side, right? This is where its risk was. But I can never, ever, ever exceed 5%. I just can't. I don't have enough capital to exceed 5%. So at some point in time, the absolute risk of a trade by having a position size that's appropriate for a trading system is actually better than a flat T plus zero line, right? Because a flat T plus zero line, like say something like our compass trades, right? Our compass trades, those have a decent amount of capital that come in them, and they're pretty flat T plus zero lines. Or maybe not our compass trades, but our cycle trades, right? Cycle trades, they start out at 0 DTE, and man, they've got range for days, right? Those things are even better than this broken wing butterfly significantly as far as their range that they can handle. So, but of course, you see the allocation on that. The allocation on that is pretty much 100% of whatever you're allowing towards options. Same kind of concept as these broken wing butterflies. So now that we've put this into perspective and we've sat here on an exact edge, remember we lost. I mean, let's say you exit at the, quote unquote, shorts, and we did that intraday and whatever, whatnot, and so forth. I mean, I still think that we ended up losing 12% or something like that, right? We'll see in just a second. I'll set that up so we can actually see if we would have taken it off at the shorts. And I do want to be clear that I don't have anything against flat T plus zero line trades. We have tons of them in our systems, and we'll have tons of them in the advanced adapt, right? That we're going to talk about tomorrow for subscribers. It has its place. It for sure has its place. It is a beautiful trade. I love them. But there are times where it's like you're leaving a lot on the table if you just don't take a little bit of extra risk on a directional basis or on a like a mispriced options basis, and you just shrink your capital size down so that way it doesn't take as much risk as what you would have done in your flat T plus zero line. So here we'll go a couple days in the future here, and I don't know what the profit target on this thing would be. But you'll also see that I'm not putting on a butterfly behind the market. There's a reason that I'm not putting on a butterfly behind the market, and I chose a horizontal spread. I'll get into that someday, but that comes back to our environmental metric and why that this structure would have an inherent edge in this moment rather than a butterfly. So you notice that it kind of had a little pop on the downside versus if I stuck a butterfly on here, it'd probably start to get crushed already. But here we go. So let's go look at that other trade. That other trade is fine. Intraday, it was back there, but our whole exit parameter that you kind of said in the comments there was, let me see. Let's see. Not all broken. Exit at short strike. Yeah, short strike. Okay. So here's short strike, expected move, right? So, I mean, this one is further out in time. So an expected move would probably be on like a weekly basis, I'm assuming. So we'll kind of use that expected move somewhere right here. We would have been tighter in this volatility regime, but we'll kind of go through this. Anyways, we're fine. Next day. And so exit at short strike at expected move. You probably would have tagged this intraday, I'm assuming, because with these types of trades, you got to watch out for these blowout risks. So you probably would have tagged this at, like, let's say it's 8%, right? And then now let's go look at our other trade that took on risk somewhere, right? It's up here at 21%, and it's being freaky because I think there's a dot way up here. Yeah, there's a dot at like 1,700%. So that's why it's all squished. It's not great, but anyways, we'll go one more day to see if we can get some real data in here. I think it's going to blow out further. Yeah, this is yet again, each trading system has its own inherent flaws. So yes, the this type of trading system we would have exited the day before for sure, because we were up so much. And that one, I'm sorry about the dots up there. I didn't know it existed until now. But we would have had all day to exit this thing. We would have put this relatively right at the same expected move, quote unquote, as the other trade. Whereas one took a loss, one took a gain. But yet again, we would have done it the opposite way as well. So if we were, let's say, quote unquote, bullish, right? Let's say there was a bullish bias or something like that. It's just, where is your potentiality, right? If we're in that broken wing butterfly trade, what are we trying to make money from? Well, in the broken wing butterfly trade, like, let's just talk about a perfect situation, right? I need to go back in time. Hold on just a second here.
He's saying that the expected move is for the expiry length too.
Oh, okay. So yeah, you're looking at, what's the expected move for 44 days or something like that. And this is going to blow that out for sure, because it was just a monumental move. But okay, so in this situation, where are we trying to make our money, right? In general, this is kind of a theta-based trade. We're hoping that the market, somewhat stays still, maybe goes up, and I don't know, there's probably an adjustment technique to deal with it going up. Because if you start running up here and you don't have some sort of adjustment technique, then you end up just making a small gain. And then it kind of makes that even worse, where you get small gain, small gain, small gain, and whop. So yeah, there's some ways to do this. If you kind of lean it, so then you start leaning it bullish, then you start to take that risk profile a little bit more, to where it's, you make more on your wins, but then on your losses, you end up blowing out a little bit too much. So you start to lean your expectancy around, and you'll find the sweet spot in like a data set. So if you start looking back in history, you'll find a sweet spot where, hey, if I exit right here, or if I lean it this much over this data set, it maximizes the returns, type of thing. And then what you end up getting into is maybe a market environment in the future that doesn't work so well on. So something like, a recession, like what we just had, and what we're about to go through. Those types of things, this type of trading system isn't going to work out very well. And there are a few people that are finding that out, as we speak. Now, what's happening, though, is you'll hear a lot about these strategies when the market is doing what's advantageous for this structure, which is straight up or sideways to up, right? So in a bull market, it's a really great structure. Honestly, in a bull market, I'd rather be long with a portfolio that takes care of all my, assets, that is dynamic, right? And then I'd like to take small shots at the market based on some mispricings and things like that here and there to offset that, right? So that takes care of that natural bullish bias most of the time in a bull market with my long only portfolio. And then take these pop shot options trades that amplifies it, right? Based on whether it be mean reversion, whether it be trend following, whether it be macro trend following / mean reversion, things like that, like our advanced adapt is about to talk about. So those types of things, you can really augment things. So instead of trying to make one trade to rule them all, right, like the one ring type of situation, if you make a bunch of different trades that deal and do very well in their own environments, that are placed on at opportune times and are risk managed well, which is about ranges, right? You talked about the rope trade earlier, which is a rope trade that we had. Let's see, put an example out there, compare it to, say, the rope trade, where a small move could mean max gain or max loss. This type of trade, I would use small spec allocation. Yeah, exactly, Greg. That's why the rope trade has a significantly smaller allocation to it than like our carabiner trade, right? They're not going to take the same risk, because one has got significantly flatter T+0 lines. Now, overall, right, something to note in that is, overall, the trading system as a whole needs to be adjusted appropriately for like an overall portfolio's volatility that we are comfortable with, right? So what I see happen a lot with retail traders is they'll take a trade like this, and because it's low volatile, like it's got low volatility to it, that's what's so appealing to it, is that it doesn't move much price up and down. Well, you can do that exact same thing in a bunch of trades that look like this, but just don't use as much capital. And then what's great about that is all that capital that's not in that can be efficiently used somewhere else, right? So instead of leaning only on this one edge and this flat T plus zero line type of thing, you can have the rest of it in a long only portfolio. You can have it, now that we've got some yields, you can have it in a bond ladder, right? You can generate yield in many other places. You can have it in, long Tesla or Nvidia or whatever the next new one is going to be, whoever's, probably Microsoft, OpenAI or something like that, inevitably, after the recession, not during this time. But, so those types of things would be really advantageous ways to efficiently use your capital. And that's something that I think gets missed a lot into retail traders that I've helped and mentored, is that the idea of why am I looking to have less directional risk? What's wrong with directional risk? Is it because I can't determine what's directional? That's perfectly okay. Like, that makes sense, because determining a direction in the market, if you don't know what you're doing, good luck with that, right? And then at the best, it's a crapshoot. So if you're saying like a 50-50 crapshoot, which, by the way, there are some of our trades that have a 50-50 shot, but they have positive expectancy. Well, why do they have positive expectancy? Well, because when they're right, they make a boatload of money. When they're wrong, they lose significantly less, right? So your expectancy gets cranked up, but it doesn't feel good, right? Like to the psyche, it doesn't really feel good to take those losses. So that's something to always keep in mind. And hopefully that kind of answers why, not only, like, I like these trades, don't get me wrong. I do want to be very, very clear that I like these trades, these broken, but I started here way back in the day doing kind of broken wing butterfly-esque type of trades. And when I started going to seminars and when I got hired at the fund, I started to realize that there's an efficiency that is more important, right? Like, hey, if I give you $100 million, how are you gonna, and you got to guarantee me some wins. How are you gonna do it? Well, I can try to guarantee you some wins in this one trade, right? But that might not work out very well, because inevitably I'm going to take a loss, right? So I can't reduce my risk so much to where my probability gets so high that I completely eliminate risk. Like, that's not possible. But what I can do is I can have a bond ladder going on. I can have a long only portfolio that's macro dynamically adjusting, like sleep well or awake, right? And then I can also have some options trades on here, and all of them together, their volatilities, say we risk parity them, or say we create an efficiency profile that each one has its own allocation, and all of those together, I can almost guarantee you that you're going to make money every month, right? I mean, I can't promise you, but you significantly reduce the probability of loss on a monthly basis, and on a yearly basis even. And I mean, even someone like Ray Dalio talked about this. If you look up Ray Dalio and Holy Grail, you start to talk about how diversification reduces the probability of loss. So instead of trying to strip out the risk on a directional basis, be okay with taking a directional basis if you've got things that actually work out well, right? Educators sold theta decay idea. That was, yeah. Well, first of all, theta is a garbage number. Greg, I'm sure you've noticed that with even some of our like daily calendar trades that are like crazy negative theta sometimes, but yet they clip away and make money by the end of the day, right? Like theta is okay, just on a Greek basis. Like just if we look on a Greek basis down here, we've got delta 27, gamma 2, theta 739, and vega negative 4,000. What's our biggest number? Right? It's vega, right? So if we're trying to sell, quote unquote time, right? Which one's going to have more pressure? Is it vega or is it theta? Right? Well, vega is significantly more powerful. So when we're, quote unquote selling theta, yes, down there at 0 DTE, right? Or especially as you get closer to 0 DTE, that becomes exponentially more powerful as far as its weight on actual theta, right? But most of the time, you're selling volatility or vega if you're a premium seller, right? And if you're a premium buyer, then you're buying vega, right? And then if you're a buyer, you've got some sort of directional component, right? Because you've got gamma the opposite way. So if you've got a positive gamma situation, then most likely you're doing some sort of scalping or you're on the edge of a delta thing, like something that we do, like that we'll talk about in the advanced adapt, is there are many times that you don't want your maximum theta, or I should say your theta. It's not theta, but you don't want your maximum time structure where the market is. You want it where it's going to go, kind of like Wayne Gretzky, like put it where the puck is going to be, like skate to where the puck is going, not where it is, right? So that's something that we'll talk about in the advanced. And yeah, so this whole idea of an income trade, it sounds nice, but could I, just let me paint a different picture here. If I've got a portfolio, a bond ladder, an options trading system, right? A directional options trading system. So, let's call it like an income quote trading system, a directional incomes trading system. And then, let's say I've got like some small cap swing trading system. I've got, say, 5 trading systems there, and they're all relatively easy to manage, right? I didn't overload myself. I'm not like day trading all 5 of these strategies. But if I've got 5 of those, right, and they're all positive expectancy, I am an income trader at that point. No one of them needs to be an income trade, right? But the odds are that all 5, take a hit to make me take a loss is very low. And then the odds are that, the way that I've structured it and balanced them all together as far as a risk management profile, they're going to be positive expectancy more often than not. And so then you end up in our minds, right? If we just kind of think about in our minds, the portfolio has a flat gamma. The account has flat gamma, right? So instead of looking at it like a trade, like I want this trade to have flat gamma, imagine if we can have a portfolio that has flat gamma. I've got flat gamma in macroeconomic environments. I've got flat gamma in up days. I've got like today, look at Awake and Sleep Well. We had a blowout day. It was awesome, right? And position sized according to however we want it to, right? Trades aren't going to have that much of an impact on it depending on how much directional risk we're taking. And it's important to take into consideration the ranges, and we're going to talk about more about some of those adaptations in the adapt advance that we're talking about tomorrow. So just kind of keep that in mind, that just have a picture in our heads about flat account gamma, flat account trades, rather than every trade needing to be like this. But yet again, I still do like this trade. I think it meets somewhere in the portfolio that sometimes I wish they had a little bit more volatility in them. Because if I've got a trade over here that has a volatility of, let's say it has like 40% drawdowns, right? So if I've got a system that's 40% drawdowns, 300% gains, right? how do I balance this trading system out with that, right? Well, what's going to end up happening is I'm going to have to put a lot of capital in this one to risk parity it. So then, well, I'm not going to do that because this thing is going, because then overall I'm going to draw down my entire portfolio's performance because its performance just isn't as high as my 300% that takes a 40% drawdown, right? So there's a balancing act that you kind of deal with in there as well. So then inevitably what happens is these trades, because they're such low volatility, and they take those big pops to the downside, you end up just not being able to allocate enough to them to make it worth your while to trade them on a regular basis. And I say that, I mean, they can still do, 20, 30% a year, no problem. I mean, you could probably do more than that on a really good year. So there's nothing wrong with them at all. It's just that, sometimes you've got things that are better. So hopefully that answers all of that. Michelle, what else we got? I know we've only got about 8 minutes. So
you got a question earlier that says, what's your definition of options mispricing? Because you mentioned that as one of the things you were looking for.
Oh, yeah. So, okay. How deep do I want to go on this one? Well, we don't have a lot of time, so I can't go too deep, but we'll save this one for another one as well. So options mispricing, there's aberrant behavior in markets all the time. And what I mean by aberrant behavior is like here today, for instance, we're gonna take today, for instance. Today, at the peak of today's move, we moved a weekly standard deviation range, 1 week standard deviation range at the current volatility levels. We did that intraday, right? Now, there's some options mispricing going on right there, I promise you. Because what has to happen in that massive move, right, in that exact moment, is all of the options above the money have to now shift over, right? All the ATM volatility, all that volatility has to push up as if that move is now the center of the market, because that's where the market is. But that one intraday move was a weak standard deviation. That's insanity. So you get this big shift over to one side, and you've got this big amount of volatility pumped up above the market, right? And so there are ways to measure these types of things. I'm not just talking about just here a standard deviation move or whatever. But statistically speaking, those options are now significantly elevated versus what is probable to sustain itself, right? So those options are significantly overvalued. And that also comes back to the fact that we price options still based on, a standard bell curve or a standard deviation, which can have its own flaws. And that's not actually appropriate all the time. Now, the market does a pretty decent job at pricing in, elevated risk to the downside, like for puts and things like that. But then at the same time, you've got the probabilistic nature of a bull market and markets in general that drift higher. So if you're putting too much pricing below the market based on that extra risk, then statistically speaking, those options are going to end up expiring zero. So there's an added edge down there. But remember, if we're a spread trader, that ends up playing out a little bit differently. So what you'd want to do in something like what I was talking about earlier today is that they're super elevated. So what you can do is you can short right above the market, go long beneath the market as a spread, right? Because that options pressure, right? That volatility pressure. And you got to make sure that the pricing actually makes sense. Like just because the standard deviation move did it, you got to make sure that the options actually did the same thing. So if that pushes, then you can do that, right? And you can grab that edge. But wait a second, that's super directional, right? Yes, that is super directional, but I'm pushing on the pressure of selling that elevated vol and buying where it's significantly depressed now because no one's long or no one's short anymore because everything's got blown out to the upside, right? So I can use that to my advantage, whether it's in the same term, whether I'm in different term structures, right? Say that it got really elevated on on close to expiration options, but not so much on far DTE options, which is likely what happened, right? So you can play those two off and then risk profile them together to where you can grab that edge and then flatten out your delta, and then just have a heyday when that starts to reset itself, which it did, I think, within a couple hours. It snapped back and all that options pricing undid. So that was an options anomaly, right? That's that aberrant behavior. That's that mispricing that we're talking about. Also, there's steady ones that kind of show up all the time as far as options mispricing. But it's very complicated to start measuring that type of stuff. But we do take those into consideration on our metric, and especially what we're going to talk about with the advanced adapt, which is where we're going to start taking into account these mispricings, and we'll talk about where they are.
You got a question. When do you think the adapt daily will start to show trades?
All right.
Very hard on that.
Yeah. So adapt daily. So just something on a little bit of a backstory about adapt daily is that we're like, here, we're in a recession. We've got this type of environment that's been going on, and let's put this together. And this is what happens a lot of the times with like trading systems that get thrown out there. Something that really gets on my nerves. But like, some person will come out with a trading system for the retail public that has worked phenomenally over the last 6 months or a year or whatever. And they'll sell it to people for $300, $500, maybe $1,000, maybe $1,500 if they're pricey, something like that. Doesn't matter, right? Whatever. It could be $5,000. The price doesn't matter, but they'll sell it to people, and then everyone will start doing it, and then it breaks. It blows up. It just doesn't work anymore. And the reason why it doesn't work anymore is because the way that they were trading that, the edge that they were specifically stepping on, is gone. Well, what happened with us, we use environmental metrics, right? So what happened is we know the trades that were working for the current environment, and what happened over the last, what was it at the time, 3 years or 4 years?
3 years. Yeah, we went all the way back. Yeah.
So 3 years. But then what just happened recently is right after we were like, here's the daily adapt. We literally went into an environment that hasn't existed back until, there's a few spots in 2019, a couple spots in 2015. There's just very few spots that environmentally that showed up. And it has a very specific signature that we measure that takes away the edge of things that we were stepping on. So if we were that person or those people that shall not be named that come out with a trading system that has worked phenomenally over the last 6 months, and I could show you amazing results, which is very easy, and then release it, it just wouldn't work anymore. It would. I mean, I think we grabbed some of our trades just to try it, and I don't think they worked at all. Did they, Michelle?
It's not
I
great.
Think they had some challenges. Well, they didn't die, but they weren't what they were designed to do by any means. So that's where it comes down to. What?
As soon as the environment changes slightly again, back into one of the many that we have trades tested up, polished, working well, we'll instantly have those trades back on.
Right.
This environment is the one that we're still working with because we wanted to get this out.
Yes.
Tested thoroughly, but out. And we have many environments tested thoroughly and already ready to go. And I was trading some of them before we got it released, and it was great. So I'm so excited also to personally get back to being able to trade these stupid trades.
Right. We were live trading daily adapt. Just great, right? And then all of a sudden the environment shifts and it's like,
And so it's not that we won't get this environment up and running as well. We will. Literally, you're waiting on how many hours in the day I have to do the back testing on this. So I'm every single free second, I am back testing this so that we can add it in. Because I'm as impatient about this as everyone else is.
To give credit to Michelle too, it's not just a one cycle thing. Like what ends up happening is that we end up, there are certain edges that we can step on during certain environments. It's just whether that edge is strong enough to offset where we have to mitigate our risk, right? So what's optimal? So, there are times that, Michelle will get through a trade. And I mean, we have many trades that work for the environment, but is it good enough, right? Is it a good enough edge? Did we balance out enough? Did we offset the risk enough to where we're okay with having that part of the system? And so that's something that she ended up having. She's having to deal with. She calls me, and then I'm like, no, we can do better. And then she's got more work to do. But that's part of the life, right?
It's always an adventure. Yes.
Yeah.
So we have something that I think is working great.
Yeah.
3 or 4 or 5 more days, hopefully.
Right.
We'll add, and then hopefully the environment won't have just changed again, unless it changes to something we already have, and that would be fantastic. That's we have most of it filled in.
We've got probably 75%.
Yeah,
we probably have 75% of the environments that we look at on there. Now, something with the new Adapt Advanced that we're going to talk about tomorrow. That's a whole nother animal as far as like set environments, because those environments impact other elements of the trades and things like that. And so you'll see kind of how that all ends up trading out. But the nice exciting thing about that is, like, I swear the daily adapts are going to pop up. Either one of two things. Either we're going to go into another environment, right? And just to be clear here, it's not like we're just talking about like a simple metric, like, oh yeah, like a vol environment, which those are a dime a dozen. There's tons of those things out there. We're looking for a very specific set of metrics for the options that we look at and where we are on the options chain. So that is not here right now for the 4 trades that we said you can use. So we've got to have either another trade or a slight variation of one of those trades that we already talked about. And of course, we went with the go-to of that we wanted to make this as less delta dependent as possible. But Greg, I mean, as you even saw, the daily adapt, there's one environment that we already have in there that's a very successful trade that we can't make an efficient enough trade without taking directional risk. So that's just sometimes that there's an environment that environment erodes the edge of being delta neutral, so much so that you just can't be delta neutral. So there are times to not be delta neutral, which we will definitely be talking about that in the Adapt Advance.
Yep.
So
the answer is soon. I hope soon we'll be done.
Yeah. All right. So macroeconomically, we kind of know where we're at with things. The portfolio is ripping, doing good jobs. We'll talk about Advanced Adapt. The Awake is doing a great job. The daily calendars, we hit new highs on recently and are bouncing up from there. We didn't have a trade on today because it was an announcement day, but tomorrow is a new day. And yeah, everything's ripping and rocking, and we've got some new things coming down the pipe.
Yep.
All right, guys.
Tomorrow. Yeah. Bye.
Until next time, Michelle, it's always awesome. And we will talk to you guys on next Wednesday at 3:30. Every week we'll be coming out and we'll just be taking questions in general, whether it be about systems that we do, whether it be about other types of option systems, other trading systems, trading psychology, behavior, macroeconomics. Shoot, we can even talk about ballroom dancing on here because Michelle is a pro, literally a pro. So
email me questions ahead of time also if you'd like, if that's easier than putting them in the chat.
Yeah, that's awesome. You can always email at info@etradingedge.com.
Yeah.
And from there, guys, we'll see you guys next time.